Hello, everybody, and welcome to today's live episode of That Crypto Show. It's Friday evening on the 25th of February. Welcome to the show, everybody that's watching out there. We are live currently on YouTube. We are also live on Twitter. And tonight we want to talk about price predictions for cryptocurrencies for 2022. And I think on top of that, I also would like to address a little bit the current state of the market. There has been a lot of stuff happening this week, which, especially if you are new to not only trading cryptocurrencies, but trading in general, probably, has caught you a little bit off guard. And I want to show you how institutional traders deal with situations like this. So really, we are going to have more or less three parts in this webinar today. I hope I'm not going to steal more than a half hour of your time, however, so it's going to be rather compact when it comes to information density. And so first of all, we are going to talk about price predictions for the cryptocurrency markets. I've chosen to introduce two models to you here, which have opposite price predictions for 2022. And I think it's very, very interesting to talk about these models and to also show the pros and the cons of working with those models. In the second part of the video, we are then going to talk about the current political situation, what that means for us traders, and how you as a trader can deal with a situation like this. And third part of the video, if we still have time, of course, we are going to do a little bit of questions and answers. So if you have any questions, feel free to write in the chat. If you're watching here on YouTube, if you're watching on Twitter, I should be able also to see your questions there. Don't be shy. My name is Dirk Hartig. I'm the head of trading education here at primexpt.com. And when I'm not doing webinars or recording videos, I'm a full-time professional trader. I have done this for over 2 decades now. To be precise, this is my 24th year of being a trader. And my goal here with my colleagues here at the Prime XPT Trading Academy is to make you a better trader so that you don't have to tap in all those little traps that linger out there that I had to step into when I was on my way to becoming a professional trader. If you like videos like this, leave us a like, subscribe to the channel. That is always for us, the best confirmation that people like what we are doing out there. If you have not done so, also follow us on Twitter, please, under xpx at px_academy. If you have any questions, feel free to get in touch with us also under academy@primexpt.com. Before we start, a little bit still, if you are not yet a client of Prime XPT, we have a special offer currently. If you open a trading account using the Academy links, you will not only become a student of the Prime XPT Trading Academy, that also comes with a lot of perks. One of those perks being, if you use this, if you use the details in the description, and one of them being using a promo code called a Trading Academy, which you can enter here, you can get up to $7,000 in bonus. So that is the more monetary perks of becoming a student of the Prime XPT Trading Academy. The other perk is, if you're a student and you write us an email to academy@primexpt.com, I will personally answer all of your questions. So you'll be in direct touch with me. I'll become your personal coach, so to say. So good timing to start it. All right, so let's jump right into it. I'm going to make my screen here a little bit bigger so you guys can see. Here we go. So first model we want to talk about today is, in my opinion, probably the most famous model when it comes to finding a fair price per Bitcoin. And I'm talking here about the so-called stock to flow model. Many of you out there probably have heard about this model. I think it was really one of the first models that were trying to find a fair price per Bitcoin and predict a price curve for Bitcoin, for the price development of Bitcoin. And it was that was not just relying, on what we see on charts or indicators and so on and so forth, but took a more scientific approach. So there's a lot of underlying math here, a lot of statistical and quantitative modeling that has been going on. And I want to quickly walk you through this model, and I want to show you why I think this is a good model, but also where the limitations of this model are, and maybe if this model is going to be invalidated in the near future. So the model itself, stock to flow for Bitcoin, was invented by a user called Plan B, which probably stands for Plan Bitcoin. Nobody knows the real name of this gentleman or lady. And so this person has chosen to not reveal their identity, which I can very well understand considering the praise and also the criticism this model has gotten, especially in the last couple of months. And this model tries to evaluate Bitcoin by something that Plan B here calls scarcity. And scarcity is something that by definition, is very hard to come by. So examples for goods that are scarce are, of course, for example, antiques. So if you own an old timer from the 1920s or 1930s, or maybe even earlier, the first Model T or whatever, this is something that is very hard to come by because only a couple of those, if at all, are probably in existence still. Another example for a scarce asset would be gold or precious metals in general, but especially gold. And gold is valuable because it's scarce, and it takes a lot of energy to produce gold. Actually, it takes a supernova, so an exploding star, to create gold atoms. So every time you have a gold nugget in your hand, this was created when a star, probably millions or billions of years ago, exploded. And this scarcity of precious metals actually can be measured by something that is called stock to flow, or in short, SF, which means nothing else that it compares how much stock of, for example, gold there is, and how much in a year is being dug up from the earth, again, to go into the stock. And for example here, so this article where he introduced the model is from 2019. So the numbers here are a little bit outdated, but it still shows what he's aiming at, in my opinion. For example, you had like 185,000, what is that, trillion tons or whatever of gold in stock. But every year there are only 3,000 tons of gold unearthed that go into the stock. So it would take 62 years of digging gold out at this rate to get to the stock. That's why the stock to flow for gold in this example is 62. Now, what he did then is to apply this also for Bitcoin, because he thinks, and I tend to agree on this, that Bitcoin also is a scarce asset because it has a limited cap. There will only be ever 21 million Bitcoins in existence. And you can very easily determine how many Bitcoins are in existence and how many Bitcoins are newly created per year. And at the moment, at the time of recording this webinar now, we have, let's round this number up, around about 19 million Bitcoins that have been already mined, that are in existence, in circulation. So we only have around about 2 million Bitcoins that are left mining. Every day, about 900 Bitcoins are newly created. If you translate those 900 daily created Bitcoins to a year, that would be 328,500 Bitcoins created. So 90 million divided by 328,500 would give Bitcoin a stock to flow of around about 58 at the moment. So it's very comparable to the number we see here, the stock to flow of gold. So what he did then is he compared where it was the market cap of gold with a stock to flow of 62, and at the creation of this model, it was at 8.4 billion. And with the same stock to flow, where should the market capitalization of Bitcoin be? And if you apply some regressions models over that, you get a graph for that. And this graph plots out, and this is the blue line on this chart, where the price, according to stock to flow of Bitcoin, should be. And what you can see here is, if we this tracks all the way back to 2010. Of course, back then there were not exchanges yet, so you had to a little bit rely on things like, okay, somebody spent 10,000 Bitcoin to buy 2 pizzas, for example. Nowadays, of course, we have new prices generated really by the milliseconds here on exchanges. And what you can see here, the blue line forecasting the price of Bitcoin actually matches pretty well what was going on with the real price here. Don't be distracted that the points here on the chart all have different colors. That always means how many days are left until the next halving. As you know, every 4 years, the mining reward of Bitcoin is cut in half here. All right, so as you can see, this used to swing widely to the upside. There were times where we went to the downside, but pretty much the real price of Bitcoin was kind of oscillating always around this blue line, where according to the stock and flow model, the price was. Lately, we have seen the price, however, going below this, because according to the stock to flow model, Bitcoin should be around 100,000 US dollars at the moment. Now we have to be careful because this is an average price. So if we, for example, after the next halving, look back, the average price, next halving is going to be mid-2024, by the way, the price of Bitcoin to validate this model should have been somewhere on average at 100,000 US dollars. So that means, according to this model, we have actually quite a nice upside still taking place, actually more than 50% to just reach the fair price. And the downside, or in order to invalidate this model, the price would need to be lower than 100,000 US dollars for several months. So it's quite normal actually for the price to oscillate around this number. For me, really, this is the first and still the best scientific work I've seen in terms of trying to get a model in terms for Bitcoin pricing. But of course, the next 6 to 18 months will really show if this model is valid or if this maybe needs to be adjusted. All right, so this quite a positive outlook, in my opinion, for Bitcoin. Next model I want to show you is a much simpler model. This model, however, predicts the exact opposite of the Bitcoin stock to flow model, because it looks at how many, at the comparison of each Bitcoin cycle. So Bitcoin cycle means what Bitcoin does from one halving to another halving in those 4 years in between, in terms of price action, and how long it took the price to reach certain points. And this model starts, because my chart doesn't go further back, actually in 2013, when we had from the cycle back then, the high here in Bitcoin at what was it, 1,200 US dollars. Then from this cycle high back then to the next cycle low, which was down here at around about 175 US dollars. It took Bitcoin 401 days, and the performance was minus 85%. This was the bottom of the cycle. After this, until the next all-time high, it took 1,069 days, until in 2017, we reached our back then all-time high at roughly 19,500 US dollars, with a performance of plus 11,300%. So, wow, if you would have bought Bitcoin back then here in 2015 at 175 euro, that would have been quite a performance. Now, in my opinion, things get interesting, because if we compare this last cycle to what we are seeing right now, we can see some really similarities that are maybe hard to just pretend that this is a coincidence. Now look at what in terms of performance and number of days to achieve this performance Bitcoin did from this high at 19,700, which was in December 2017, until the low of the current cycle, of the last cycle, I'm sorry, which was at roughly 3,000 US dollar. The price fell by 84%. So remember, in the cycle before that, it was 85%, now 84%. It took 364 days. So this is really not so far away from those 401 days we saw in the cycle before, right? And now it gets more eerie in my opinion, because then from this low we saw there in December 2018 until our all-time high that we made in November 2021 at 69,000 US dollar, it took 1,063 days. And if you compare those 1,063 days to the 1,069 days of a cycle prior to this, you know, the assumption really easy could be here that, okay, maybe this was really the new all-time high we saw there, and we have entered a bear market. And if the bear market behaves exactly the same like it did back in the phase from late 2013 to 2015, and from 2018, December 2018, December 2017 to December 2018, we can do the following forecast for Bitcoin. Bitcoin then should make a bottom round about 364 to 401 days in the future. Remember, those are here, the 364 days, the 401 days. And it should bottom out at somewhere between minus 84 to minus 85 or 86% from the last all-time high, which would give us a projection of Bitcoin bottoming somewhere between the 9th of November 2022 to the 16th of December 2022, with a price target between 9,660 US dollars and 11,040 US dollars. And now you might ask yourself, okay, this is like really contradicting each other. So one model really says here, we should see a price of 100,000 US dollars. Now the other model says, no, we've seen the all-time high already, and we are going down now. And in my opinion, it's important to take both into account, because this is what it's all about to be a trader. You don't just want to be focused on one thing that can happen. You always need to have a plan B. Plan B, I don't mean the model of plan B now, a plan B when it comes to trading. So what am I going to do if the plan B model is right and we are going to see Bitcoin oscillating around 100,000 US dollars on average until the next halving? Well, in that case, of course, this other model that predicts a new cycle low is going to be invalidated. But I will know then in this case that, hey, if the price is somewhere around 100,000 US dollars, maybe I should not bet for this cycle too much anymore on further rising prices. On the contrary, if this model really becomes true and you see in late 2022 somewhere prices here between, let's say, 9,500 US dollars and 11,500 US dollars, then you probably have a good chance of somewhat catching the bottom here for the next cycle to rise upwards. And if the next cycle is just going to be like this last cycle, with a plus of 2,225%, this would then put the next Bitcoin target well above 200,000 US dollars somewhere here. So that's quite a nice gain, right? If you really would be able to bottom fish Bitcoin there around 10,000 US dollars, and then later on can sell it over 200,000 US dollars. So what I mean by this is really by, putting in a little bit of effort, reading about models like this, you can prepare as a trader mid to long term for different scenarios. you will very rarely be caught off guard. Whereas if you are just focused on no, Bitcoin has to reach a new all-time high, this cannot be it has to reach 200,000 US dollars or 300 or 500,000 US dollars, and then the opposite happens, you will be frustrated because not only will you have lost a lot of money, but the harder thing even is that you will have been proven wrong. So you might prepare your B game then, so to say, after your A game, and prepare for both situations to come. All right, good. That on models. So you've seen two scenarios that could happen over the course of 2022 now. And just because I did this on Bitcoin, you can translate this to every other cryptocurrency out there, because with the moves we are talking about here at the moment, every other cryptocurrency in the top 20 or top 50 will follow those moves. Of course, to a greater or to a lesser extent. But really, if you have nailed down somewhat the moves of Bitcoin, also in day trading, you've pretty much nailed down the whole cryptocurrency market, in my opinion. Good. Next topic I would like to talk about today is what we are currently seeing here on the financial market. I think it's a really special situation. Excuse me. A situation that we have never seen really here, at least in Europe. We have I have to say it like this, war going on there between Russia and the Ukraine. And as a trader, of course, I'm not a political person, but obviously this also affects the financial markets. This also affects trading decision. And I think this is something we have not seen in the past 10 years, and a prime example of what I like to call risk on and risk off. So as institutional traders always think in risk on scenarios and risk off scenarios. A risk on scenario is pretty much what we've seen the last 10 years, would be that institutional investors are looking for so-called risky assets, where they, of course, risk more money, but in return have a higher chance of having an above average performance with that asset. And very prominent examples for those so-called risky assets are, for example, the stock market or also cryptocurrencies. So whenever investors are looking for risk, they will invest in cryptocurrencies, they will invest also in the stock market. The opposite of this, and this is what we are seeing at the moment, is a risk-off scenario. A risk-off scenario is a scenario where something happens that makes investors look for so-called safe haven investments. And this can be cash, this can be treasury bonds from well-denominated corporations or countries, for example, the USA. This can be gold, this can be commodities such as oil, and this can also be a currency like the US dollar. And this is really what we are seeing here at the moment. So what we've seen here in the last days is not only stock prices really going hard down, and you can see this, the S&P 500. So let me change here to the last month maybe. We've seen really here from the high that we saw the last high, 10th of February, stock prices going sharply down from around about 4,000. This is the S&P 500, so the most important stock index in the world, by the way. So from around about 4,600 points to 4,150 points. Of course, we are seeing a little bit of a recovery now again. Nonetheless, prices have declined here. And if you look at other risk-off assets now in this case, for example, the prominent example would be here gold. You can also see here we've seen in the last really 6 months really strongly rising prices for gold. Gold nibbled there yesterday or already on the mark of 2,000 US dollars. We see today a move into the opposite direction. What that means we're going to talk about later. But typical risk-off behavior here really is gold as a store of value, classic store of value that institutional investors will seek out in risk-off scenarios, because they don't want so much return. They want the money to be safe. And of course, investing in gold doesn't give you any form of return in terms of, for example, dividends or interest rates. And the same picture really we see here all over the place. We see the US dollar becoming stronger. Remember, euro US dollar, when it goes down, it means the US dollar becomes stronger because you have to pay less US dollar per euro. We were there already under 112, regained this a little bit. So we are seeing a rebound day. But also here, if you look at the development over the past 6 months, we've come all the way down here from 122 to in the lows almost 111. And this is because also institutional investors are buying the US dollar in form of US Treasury bonds. So there's a high demand for the US dollar. And this can be seen all over the place. And the question, of course, now is, what can I do as a cryptocurrency trader in a scenario like this? Because this is not a scenario that is, really well known, maybe, especially to people that are new to the market, to see volatility, crazy volatility like we've seen really in Bitcoin. So let me open a Bitcoin chart here from yesterday, really. Not this one. Let's take the long-term chart here. That will do. So if I zoom in here a little bit, I mean, look at this candle from yesterday, where we were in the high at almost 40,000 US dollar, and the low was 34,500. So we were really swinging to the upside and downside by more than 10%. And this is extremely, extremely difficult if you are a cryptocurrency trader, because you are very, very fast caught off guard, or you are kicked out of your position, maybe because you have your stop loss too tight. But really, when the markets are swinging up by more than 10% to the upside and to the downside, it's really, really hard to trade. And then it's perfectly okay, in my opinion, to say, okay, I'm going to keep my cash on my trading account. I'm going to step to the sideline. I'm going to just observe a market and not, for example, do day trading, because first and foremost, of course, as traders, we have to keep our money, so to say, secure. We don't want to lose money. And with this kind of crazy volatility, it's, of course, hard to not lose money, or when you enter a position, to not get very, very nervous because it suddenly starts swinging against you with 5 or 6%, and maybe you're even leveraged with 1 to 20 or 1 to 30 there. And so that's perfectly a good thing. But to get the arc back to the valuation models we've seen in Bitcoin, a situation like this can also be a great chance. So if you, for example, say, hey, this model by plan B, the stock to flow model, actually makes a lot of sense. This is really solid. This is mathematically, statistical proven, makes a lot of sense to me. I believe we will see Bitcoin eventually reaching those 100,000 US dollars. Well, then these times like these are a perfect buying opportunity. And you actually don't need to throw all your money onto the market at once. What you can also do then is, let's say, if you want to invest, I'm just making something up now, 10,000 US dollars into Bitcoin, you can have limit orders ready. Buy some here. Have a limit order at 37,000, maybe at 35,001, maybe at 30,000, maybe if you think it's going even lower, at 25 or 20,000, and so on and so forth. So those are also often great chances to scale into the market, but of course you need to have the courage for doing so. All right, good. Are there any questions today regarding this? I see there a question concerning gold against US dollar. What would you like to know? The Trading Simple Para Todos has asked this question. How can I help you with gold against US dollar? Okay, maybe a bit too shy to ask now, but no problem. Let's have a look at gold against US dollar quickly. So I was showing this earlier already. Where do we have metals? Here we go. Let's look at gold. And Like only basic. Okay. So what we are, like I said, what we are really seeing here at the moment is typical US dollar getting stronger, thus gold also getting stronger. Very typical for for times like this where there's a lot of insecurity in the market. You'll always see, or most of the time, then see gold up. I would be, however, very careful because I think a lot is priced in already in the market. And we see this by the reaction, by the way, today. We've seen those massive sales, this massive dip in cryptocurrencies on the stock market. For example, yesterday we saw oil jumping over $100 per barrel. We saw gold attacking 2000, and just one day later we see the total opposite. Yeah, Bitcoin suddenly up 10%, the stock market performing well. And by the way, if we see this for the stock market by end of tonight, so in about 1.5 hours, I think it is, the trading session for the New York Stock Exchange will end. And if we really see that the S&P 500 closes around plus 2%, that would be, in my opinion, an extremely bullish sign. And that would also mean that probably we're going to see gold dropping further. Because imagine, the stock market is not going to be opened, and likewise the market for gold, obviously, until Monday morning. So if we don't see a sell-off in the last half hour of trading on the New York Stock Exchange, but we close with a solid plus, that means the market is expecting then that probably this crisis we are seeing there between Russia and the Ukraine is going to resolve itself. And in those 2 days, a lot of stuff could potentially happen. Just a week ago, probably nobody would have believed that we are going to see this war, and now it's happening. So a lot of uncertainty in 2 days, but still the stock market believes that this thing is basically over and priced in already. So what I mean by this is, if you happen to see this and really watch for the last half hour of trading action on the New York Stock Exchange, so starting in 1 hour, this last half hour, and you watch the New York Stock Exchange, you watch the gold price, and if you see the stocks are closing strong, you can be fairly certain that we've probably seen the top around $2,000 in gold. So I wouldn't go long gold then anymore. However, take this with a grain of salt. Of course, I don't have a crystal ball here, and I cannot forecast what is going to happen on the weekend in terms of the crisis that is brewing there at the moment in the outskirts of Eastern Europe. All right. Any more questions? I don't think so. All right. Then in that case, have a great weekend, everybody. Ahead, I'm going to see you again next week on That Crypto Show. Stay safe. Always remember to use the stop loss, and take care. See you. Bye-bye.